Hello and welcome back to The Note. We've had another turnaround day today, as you can see from our first chart, which shows you the S&P 500 minute by minute through the day. The rest of the world stock markets generally had a bad day. That meant you saw a big fall at the opening. Then you saw a general recovery in the oil price, and you also saw a recovery in US stocks, which closed actually up for the day. Means there's a good chance that you'll see other stock markets around the world open upwards when they reopen. Let's now talk about the biggest topic for the day, which continues to be sterling. It dropped below $1.40 and then $1.39 today, fresh post-crisis lows, actually below purchasing power parity, which most people put in the low $1.40s. So arguably it's now actually below fair value for the first time in many years. Is this because of fears over Brexit, over leaving the European Union, or is it about fears of steady growing deflationary problems in the UK? Well, this following chart provided by Capital Economics of London suggests very clearly that it is about Brexit fears. If you take a look at the red line, that shows you the gap between US and UK interest rates. You can see that at one point there was a belief that the UK might even raise rates ahead of the US. That's very firmly off the table now, and you can see that these two lines very much follow each other. The dollar-pound exchange rates traced gaps in rates very closely. In the last couple of months, however, there's been really no shift in the rate differentials while the pound has sunk very dramatically against the dollar. Capital Economics suggests, and I would agree, that means that we can attribute pretty much all of the fall we've seen so far this year to fears over Brexit. Now, as betting markets put the chances of a Brexit at the moment still at only about 1 in 3, that would imply that you could see a further fall to about 120 if the UK actually goes through with leaving the EU. We would only be about 1/3 of the way through that extra fall in the pound that we would see if the UK actually left the EU. So the message for UK voters is fairly clear. If you want to play currency wars and engineer a really big devaluation, vote to leave the European Union. Now, full disclosure, as a British person living in the States and being paid in dollars, this is all extremely good news for me, but it's still questionable whether I can really afford to go home, because if we take a look at this chart, you can see the sword of Damocles hanging over the UK economy, which is the housing market. This is in local currency terms, which I think is relevant for looking at the impact of house prices on the economy. You can see that in the case of the US, there was a bubble which burst and corrected and then started a small, steady recovery. In the case of the UK, there was a much bigger bubble which barely corrected before it went on another rampage. There's been deliberate policies by the government to try to boost house prices. There's a long history that the UK economy is very much driven by house prices. When they're rising, things are great for the UK economy. When this bubble finally bursts, we have plenty of experience that things in the UK economy could be rather ugly. They might need a big currency devaluation.